crash interest rates. Get it.
Daddy Powell. The numbers are flying, red, ink, and green. For some it's a nightmare, for others a dream. Degens are crying, theories disavow, all bending the knee to mighty Daddy Powell. Oh, Daddy Powell, oh, Daddy Powell. Every single time, it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on Oh, Daddy Powell! No! Oh, Daddy Powell!
Oh, brother, oh, brother, oh, brother. Good afternoon, good afternoon, good afternoon, and happy FOMC Day to all who celebrate. Folks, it's about to go down. Well, in fact, the market just went down, and now we're getting a little bit of a pippity-poppity back to the upside. Why is my elbow hurt? What am I doing here? Why? What's going on? What's going on? Why is my elbow feeling the way that my elbow feels? Anyway, that is besides the point. We have more important things to talk about, such as the old stonk market. We rippity-skippity up until about 1040. We drippity-droppity up until about 130. And now we're getting a little bit of a baby-pippity-pop. So pippity pop, drippity drop, back to a pippity pop. And really, surprise, surprise, we're just getting pinned to the all important level of 6,000. Folks, it's going to be a binary event here. We're either ripping or we're dropping, or there's going to be fake outs or maybe not fake outs. We've had it all on days such as today. This is all going to get rocking in about 10 minutes. That's when we get the release of the FOMC decision. But more important than the FOMC decision, which just to show you here, just to drive the point home, there's a 99.9% chance, 99.99 that we stay at 4.25%. So no one's going to be surprised here. No one's going to be surprised here. The market is very confident nothing's about to happen. No rate increase, no rate cut. Those are the odds right there. So what's really going to be moving the market is referred to as the summary of economic projections. If you're ever on a first date and you really want to impress the chick, just start talking about the SEP. And if she doesn't know what the SEP is, maybe she's just not the girl for you. But you see how every other one, it goes press conference, but then there's projection materials. So basically every other FOMC meeting, we get the projection materials. You come here, you click on it, and you could see this is what we got last time. We were checking out right here, summary of economic projections. It is the SEP. And right away, there's two things that people jump to. First of all, here, you get to see the previous projection for things such as GDP, unemployment rate, PCE inflation, core PCE, blah, 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 Fed's fund rate. So you see their last projection, and So obviously the last one are going to be these top numbers right here. And then you see the new one, and it's just the median value between, I believe, the 18 or 19 voting FOMC members. So we're going to get to see, are they higher or lower than 1.7% on GDP? Are they higher or lower than 4.4% on unemployment? And same thing with inflation, and same thing with the Fed's fund rate. So we're going to get a better idea of kind of where they are at. This is effectively the most up-to-date understanding as of like today, because they're just literally discussing it between yesterday and today. So they're redoing all these numbers, and we're going to get those. And then we're also going to get what's referred to as the dot plot. And that's exactly what it sounds like. It is these dots right here. And this is them just voting on the various things. So we get to see, are they all really kind of coalescing on a certain level? Are they spread apart? And you get to see how many dots of these really do or don't change. So we're going to get their idea of projections for 2025, 2026, 2027 in the longer run. So this is what people are going to be reacting to at 2 p.m. And then from 2 to 2:30, people are just going to be going haywire, and you're going to have margin calls and liquidations because, of course, there's a bunch of people tilted way too much. So that's going to be fun. And then at 2:30, Jerome Powell himself, the chairman of the Fed, will be doing a live press conference. He will be doing basically prepared remarks, and then that will be promptly followed up by a barrage of questions that will most likely last until about 3:30 p.m. ish. So that's where we're at. Obviously, here's how prices are. Most importantly, I think it's just kind of, we went above the 6,000 level, we went below the 6,000 level, and now we're just back at the 6,000 level. So the market's just kind of waiting at that moment. With respect to options, the Mag 7 ripped until about noon, and a little bit of a breather, strong recovery right now. S&P 500 pop, drop, pop, jagged. Like, we're basically just going above and below equilibrium, above and below VWAP, above and below 6,000. This is classic indecision from the market, a bunch of freaking undecided candles, and we're just waiting. Just waiting. I can tell you with 99.9% certainty that there's going to be no change to the rates. If there is a rate cut, holy shit, things are going to go crazy. But once again, there's about a 0.1% chance of that happening. So I wouldn't be betting on it. But if it did, your boy would probably become a multi-millionaire today, because the market would rip to the high heavens. And I have a bunch of calls right now, so that would be insane. But like I said, there's about 0.1% chance of that happening. But I feel like it's like almost the Dumb and Dumber thing. The Dumb and Dumber means, so he's like, so you're saying I have a chance? That's pretty much where we would be at. So not really going to happen. But the idea here is we're going to get from the SEP somewhat of an idea of where we might be getting a rate cut, or I should say when we might be getting a rate cut for the first time. Right now, the odds are for September. It's greater than not, but maybe they speed up to July, or who knows, maybe they kick the can down the road to the next meeting at November. So that's what we're going to be finding out in about 6 months, the first phase of it. But remember, the data comes out at 6, the summary of economic projections, and then all the talking heads on social media are going to try to break it down, and then it doesn't really matter, because at 2:30, that's when we hear from the chairman of the Fed. Now, before I get going, just in case I forget, shout out to Spot Gamma, the partner of today's stream. If you want to track the options flow the way I do, and I don't even know how you'd be able to trade without it, use that link pinned to the top of chat in the description of the video. You will get 80% off. And then also, if you want to trade with someone else's money and lower your own risk, shout out to Take Profit Trader. Remember to use that code Goonie, also pinned to the top of chat in the description of the video, to get 30% off and never pay an activation fee. Obviously, shout out to Take Profit Trader and Spot Gamma. I literally use those tools all day, every day. So show them a little bit of love. The links and the codes, just check them out, pinned to the top of chat in the description of the video. All right, we're seeing a little bit of, we basically had a huge bounce this morning, a slow burn off, and now we're getting a bit of a pop. The Mag 7, a bit of a recovery there. The SPY, a bit of a recovery. This little craziness that we saw basically starting at 120. I could show you what's going on here. I could show you what's going on here around 120. It was this one. Iranian Deputy Foreign Minister. Iran will respond if the U.S. joins Israel's war with Iran. So I think that was pretty much a no-brainer. In fact, I'm very surprised the market cared about it whatsoever. Alas, it did. So something to pay attention to. something to pay attention to. All right, folks. So that's the setup for what in the world is going on right now. I have no particular insights or anything like that. I am hopeful that the market rips. I am hoping, but that's all it is. I don't have any particular model or prediction on what Powell will or won't say. My only prediction is that we're not going to get a change to the Fed fund rate. That's my major prediction, and I can say that with 99.9% accuracy. Now, will the market react positively or negatively to everything else going on in the SEP, to what Jerome Powell has to say? Your guess is as good as mine. I'm flipping a coin, and I'm telling you that I am hopeful that it goes up. I'm hoping we land on the head side, on the bull side. So if I could wave a magic wand and make something happen, I would have this thing rip to the high heavens. But do I have any sort of mathematical backing of what I think is going to say with the Fed meeting? No. Your guess is as good as mine. I'm sitting here in the hot seat as much as all of you guys are. So should be an interesting one. It should be an interesting one. So we have about 2.5 minutes to go. So in the final 2.5 minutes, 150 seconds. If you haven't already, please hit that like button, because it's just going to get this show out to more people, so they're all watching it with us in real time. So if you're watching this show right now, if you can hear me loud and clear, just hit that like button super quick. It's obviously free, but it very, very much helps me out. Do that on both Rumble and on YouTube. And other than that, I would love to know your thoughts. What do you think? So we're just below 600 on SPY. Do you think from now to market close, we're going to be above 600 or below 600? Where do you guys think we close on the day? And specifically, I'm asking anyone in chat who's feeling uniquely lucky today. This feels like it's very much going to be, you know what, folks? How much time do I have? I have 2 minutes. That is perfect opportunity. Perfect opportunity for us to get some real answers here. This is the perfect opportunity for us to get some real answers. 3, 2, 1. All right, cool. Abracadabra, alakazam. Oh, market lords, where will you be leading us today? All right, whoa. We pulled the 2 of swords, and that little kitty cat has a scar on its eye. And even though it has a scar, clearly battle tested, notice how the eye is still fine. That's an interesting one. Feels like we're going into a battle, but yet somehow we're going to end up being victorious. The 2 of swords. Where in the world is the 2 of swords? 2 of swords, 2 of swords. A state of precarious balance. Oh, golly. Precarious balance, you say. Here, let me get over to the 15 second. Let's get this up. I guess we are in a state of precarious balance. Tension, status quo, stalemate, a state of precarious balance. At the moment, everything may appear stable from the outside, but the balance cannot last. There is a refusal to come down on one side or the other. Disruption is inevitable and solutions must be found. If your instincts are unclear, seek advice, perhaps from a counselor. Health may be jeopardized by doing too much for others. You don't have to tell me twice. You don't have to tell me twice that my health is being sacrificed. My mental health is being sacrificed every freaking day in these markets. All right. Well, initial pop to the upside. Initial pop. We got some bulls. We got some bulls reacting to the SEP. Oh, golly. Initial reaction, a bullish one.
Change in the Federal Reserve funds
we
rate
need that.
staying at a net level of 4.25% to 4.5%. Some really interesting stuff in the forecast. Let me tell you about the assessment of the economy first. They're saying the economy continues to expand at a solid pace. Unemployment remains low. Inflation is somewhat elevated. And they talk about the idea that swings in net exports, all that front running, is affecting the data. Now, they're expecting
GDP to go less, unemployment to go higher, inflation to go higher, and the Fed funds rate is expected is as the same.
And
yet we went up.
To the upside for inflation and to the downside for growth. Let me give you some numbers here. 2025 GDP now 1.4%, down from 1. 2.7, which was down from 2.1, so pretty much a very similar drop. Core PCE, 3.1 from 2.8, this is for 2025, from 2.5. So two big step ups in the outlook for core PCE this year. Risks on core weighted to the upside. Unemployment, 4.5, had been 4.4 before that, 4.3, so steadily stepping up on the unemployment outlook. Now, the question you really wondered about, which is, what did they do with the outlook for rates? Still 3.9% for this year. 7 officials did not want a rate cut at all. That's up from 4 in the prior outlook, but it remained the same because some other folks came down a little bit. 2026, the conversation Brian and I were having just before at 1 o'clock, they did eliminate 1 rate cut down to 3.6 from, or sorry, up to 3.6 from 3.4. And then again, that remains in place for 2027, 3.4 from 3.1. Inflation is seen declining in 2026. That's important. We passed through it, but not as much as previously forecast. Growth recovers in 2026, but again, less than previously forecast. The Fed says uncertainty remains high about all of its forecasts. The Fed said in the statement that uncertainty has diminished, but remains elevated. But if you look at the measures of uncertainty, which we talked about at 1 o'clock with Brian, those all remain
These numbers
elevated.
don't
Guys,
seem that good.
So very quickly, Steve, back to you, kind of writing all this stuff down. Higher inflationary expectations.
Yeah, these numbers
lower
do
growth.
not
You mentioned the
seem
S word,
positive.
stagflation. I would imagine that makes the Federal Reserve's decision-making a little bit harder, because that is not a great combination.
I think
across the board,
inflation
inflation expectations are up, unemployment is up,
further step towards
GDP is down for 2 out of 3,
September, but this forecast
and the Fed fund rate the same, higher and higher. This is not good, dude.
About cutting rates in September. This one says, you know what? Whatever I had last time, I'm pretty much increasing the inflation rate.
This
and
makes more
decreasing
sense
the growth
that we're
rate
going.
by almost the same measure
not good.
as I did from December to March. I did again from March to June.
All right, let's go now. Steve, stick around. Let's go back to our panel to get some reaction. Francis, I'm going to go to you. Electrical grid aside, let's talk about expectations. Because again, no cut right now, but we knew that. Okay, not one person thought there was going to be a cut today. But when I'm looking at the end of this year into next year, the expectations, the dot plots, are all over the place. Where do you and RBC fall?
Well, we expect the Fed to cut later this year, but look at the balance of shifts in these forecasts.
Pretty much unchanged from right before.
Stagflation light to maybe stagflation moderate, and this is going to be the story for the U.S. economy. Inflation is just slightly too hot for comfort. A 3 handle is a psychological level that matters, and we're coming in below on trend growth. And all of the news that has happened in the last 2, 4, 6, 8 weeks is going to push us towards even higher inflation forecasts and probably lower growth. That's going to continue to put tension on this dual mandate. So we're going to focus a lot on this SEP and what these forecasts mean. But Brian, next time they're going to change again, and my expectation is for an even higher inflation number and an even lower growth number.
I'll go back to you quickly, Francis. Why do you think they're going to change again? Why are you so confident in that?
Well, they'll have to. I'm not sure why they say uncertainty has diminished. I wish I was that confident, but we have a series of ongoing shocks that have yet to be felt in this economy, and I think these numbers are still a little bit light on the inflation side and a little bit too strong on the growth side.
David Kelly, would you agree with that the future is fairly cloudy? We don't know what's even going to happen in the Middle East, inflation, energy prices, etc.
Yeah, I think it is very cloudy. I will say that since the last meeting, I think some of the tariff uncertainty has diminished. I mean, the tariff rates are not what they were on April 8th. But the thing that strikes me is if you look at that forecast for the end of this year, they think that 4.2% is the right unemployment rate in the long run, and they think they're only going to be 0.3 ahead of that. But they think that 2% inflation is the right number in the long run. It looks like they're going to be more than 1% above that. So, you know, Jay Powell said, you know, if they're both off track, we're going to look at how far they're off track and how quickly they get back to that track, and that suggests that they'll be very reluctant to cut rates until that inflation number comes down.
So, David, back to you again, and you nailed it, and I want to hear Jim's thoughts and Steve's and everybody's. When I hear inflation is expected to go up, my
that's not good.
Little brain immediately goes to higher rates, not lower rates.
No, I think they'll hold rates longer. I mean, I think they could hold rates all the way till the end of the year, because I think they know that, look, if this is tariffs, it will fade in 2026. Even if you get a sugar rush from fiscal stimulus from this bill going through Congress, that sugar rush will fade. Sugar rushes do. And so by the end of next year, that's a long way away, but by the end of the next year, the economy should be cooling down, inflation should be cooling down, and maybe then they can give us some lower rates. But right now, do not hold your breath waiting for low rates from the Federal Reserve, because they don't seem to have any intention of delivering them.
Jim, Karen, I can't see you right now, but are you holding your breath? I mean, do you think that could we be on hold for longer?
So let me start with the punchline. The punchline is that the Fed did not change their 2025 forecast for policy rates. To me, what that says is that they haven't really changed their position on anything. What has changed is the distributional outcomes, the possibilities, the confidence level that they have in the risks for inflation and employment. So what the Fed is basically saying is that the risks to inflation are skewed to the upside. The risks to unemployment is also skewed to the upside. This is what I think is somewhat being confused as a stagflationary event for markets. This is really about a risk distribution. So if the risk distribution is suggesting that there might be higher inflation and that the unemployment rate might move higher, but they're unwilling to change their policy rate, then really what they're telling you is that the dispersion around what the Fed forecasters has grown. And we've seen that. So you said that we went from 4 people calling for no rate cuts to now 7 people calling for no rate cuts. That's the big news here, is that we're moving towards a no rate cut environment going forward.
Yeah, and Steve Leishman, you got, you've got obviously your Fed survey, so you know what people expect. And looking at it 4 months ago, 3 months ago, 2 months ago, now, and then looking out, are you experiencing that same level, to Francis's point, of sort of uncertainty? And in an uncertain environment, people tend, not always, but often, to do nothing because they don't know what to do.
Yeah, a lot to unpack here. First of all, the Fed survey was spot on, Brian. I'll just point out we were at 390 for this year and 355 for next year. So that really gave people a heads up in that Fed survey of where people thought the Fed might be for 2026. And I agree, there is a massive dispersion around outcomes, but the median official is still on that 3.9 or 2 rate cuts. I think there's good news and bad news here. The first good news is that, well, I'll give you the bad news first. The bad news is the Fed clearly believes inflation is to come from tariffs. They do not believe, at least I guess the median official does not believe, that we're out of the woods on tariffs.
Spy holding green on the day. He's holding green on the day.
The tariff inflationary impulse to pass through the economy into 2026.
Powell will be coming on in 20 minutes.
Maybe even enough sometime in the second half that there's more clarity.
Options are jagged, but attempting to hold.
The point is, right now, they did not make that movement today. But I think the point that was made earlier is right. They still see themselves going that way. They just ain't in any particular hurry to get there.
I love what Steve just said, Francis, because it reminded me that the tariffs are still a gigantic unknown. 2 months ago, that's pretty much all we talked about, was tariffs. We're at the Port of Long Beach. What's going to happen? The president kind of walked those back. Now we're talking about Iran and Israel, Middle East, inflation, energy, and yet the tariff situation is still hanging out there. I just don't know if I was a voting member of the Fed, how I would have any visibility whatsoever, not just around the Middle East, but around tariffs and how countries react.
Brian, I know this question is for Francis, but I want to just remind you of something. Do you remember at the last press conference, Powell challenged the reporter and said, "What would you write down?"
But that's why we get paid the medium bucks, because we don't actually have to do anything. That's the beautiful part, Francis. We don't actually have to make decisions. You do.
Brian, here's the thing. We know 2 things to be true. There's a lot we don't know. We don't know what the future of immigration policy is going to be. We don't know what that one big, beautiful bill is going to pass like. But here's what we know about tariffs. The average effective tariff rate in place is 14 to 15%. That is the largest trade shock in 100 years in the United States. That's what's in place right now. That is true and fact. Second thing we know is it takes a few months for tariffs to work their way through. Inflation depends how much inventory is in the system, but we know this from history. So what do we know? There's a major trade shock. You're right, we don't talk about it enough, and it has yet to play out. But it's not just tariffs, Brian. We have a big energy shock that just happened in the last few days. When I take a first scan here, it feels like that's not even factoring into the story here, and it needs to.
Yeah, well, because there's so much to focus on. We have a 4-hour show, Francis. Might be able to do it. We have like a half an hour. Very quickly, final comments from David and Jim as well. David and Jim, same question to both of you. David, I'll start with you. We just talked about all the uncertainty. What is David Kelly most watching next? What's the next big thing for you?
The exact details on this big stimulus
honestly,
bill, because
options are kind of flat in all of this. They popped, and then they gave them back. Calls are flat.
Depending on
Puts
income tax refunds,
flat.
because a lot of these tax cuts start on January 1, 2025. That means big refund checks, and that could sugar up the economy in the first half of next year. And I'm sure the Federal Reserve is looking at that, not just the tariff issue. Because if it's just tariff inflation,
well, let's see if Powell wants to save us.
Followed by stimulus, then this inflation could
we ain't
last a while.
done yet.
Jim Caron, you and Morgan Stanley, what's the next big thing on your radar?
So I'm going to take a slightly out of consensus view, and I'm going to say that a lot of the news regarding tariffs right now, all of this uncertainty is going to start to pass as we go into the second half of the year, and it's going to become more like, known unknowns, essentially. So effectively, what I'm saying is that as the tariff uncertainty starts to pass away, we get the effective tariff rate, we know what it is. The risk is to the upside in the sense that if the economy does not deteriorate as much as people think that it will, then there's going to have to be a pretty big adjustment, not just in interest rates, but also in equity prices. And I think that upside risk is not fully appreciated right now. And we're seeing that in the skews in the dynamics for equity forecasters and even for where policy rates may actually end up being. So I think the boat is heavily tilted to the downside in risks. And I don't think that there's enough weight on the upside. And we want to play this in a balanced way. So diversifying a portfolio and repositioning ourselves to account for that is going to be very important.
30-minute,
I know a lot of people have Steve Leishman because they've been investing in Europe where he's had a lot of rate cuts. I know the president's talked about
Tech's
that.
a bit heavier.
Very quickly, cherry on top of this whole thing. I know you got to go into lockout. Is the big takeaway, at least until we hear from Jay Powell, is the big takeaway that we are likely to go longer without rate cuts, or did I miss something?
Well, I was just interested in Jim's use of the word these tariffs will pass. I was like, pass how? Like a kidney stone or a sailboat on a quiet summer night?
I was thinking gas, but actually, that's where my mind goes.
So I think there's two ways this could happen. I think Jim is right. Eventually, the market will have enough information to price this in and put a price on it. There is maybe an upside that I haven't mentioned here, which is that if the inflation forecast is 3.1 on core CPI, or core PCE, but the Fed is still forecasting the 2 rate cuts, does it tell us there's more tolerance by the Fed to still cut rates amid higher inflation? I think that might be a question that may be worthy of the Fed chair.
Well, you get to ask that question because you're going to go into the Fed lockup in about 15 minutes. That press conference will start, and you're going to get a chance to answer that as well. Jim, David, Francis, Steve,
pretty much
thank you
right
all very
back
much.
to where we were.
We're going to go to Rick Santelli, but very quickly, folks, I want to show you
they're bringing on
something
our
called
boy
the CME
Rick.
FedWatch tool. And here's how confusing it is for next year. And Rick, I know you can hear me, so we'll bring you in.
Yeah,
maybe you can
get our
comment
boy
on this,
Rick.
because you're in Chicago, by the way. There are all these different expectations for rates maybe 1 year, the June meeting next year, 2026. There are 6 different levels between 2.75% and 4.14%. So 1.5% variance, which is a big deal for the Fed, in where the Fed may be. I guess my point, Rick, is it that cloudy next year?
Yeah, hell yeah.
You know, I don't think it's that cloudy because I think that the weather projections are never very accurate. Just think about the past. How many rate cuts were built in?
Dapper,
how few are built in now? In the end, I love our Chicago products, and I think it's interesting to know what investors think is happening down the road. But to think that the accuracy of anything in the Fed fund futures or option world that far in advance has a high degree of accuracy, well, it doesn't. It's only accurate given the inputs that we currently know. So I think it's always nice to know what investors are thinking, but I wouldn't look to that to be any sort of reality. I think the reality is that the markets, as Jim Caron said, maybe we're going to pass this by. I'll tell you what's passing by. Many people's 401ks are passing by golden opportunities. Look what the market has voiced over the last month with regard to equities and interest rates. And just today, if you look at the moves in the market, 2-year yields are a bit lower, but they're coming back. Only a couple basis points. 10-year yields are a little bit higher, so the curve is steepened. But virtually, if you blur your eyes, markets haven't moved much. And if you look at the dollar index, it's almost exactly where it was before the statement was read. What are the markets saying? They don't really see anything new here. And in terms of tariffs, I'll tell you what, the Fed used the word transitory.
We're still
maybe
just
not
pinned
in a good
right
way.
to
I'll use it.
6,000.
I think tariff agita is transitory. And the problem with that is that you won't be able to go back in time and do all the trades that uncertainty is keeping people from doing. I don't know if the future's ever been very certain, but I could tell you this, that the opportunities in many markets remain large because the uncertainties kept so many players on the sideline. In terms of the crystal ball and the dot plots, I never found them highly accurate.
Well, because they can be changed. If you don't like the dot plot, you just change your plot. So it's like, what time is dinner? 6 until it's 7, and then it's at 8, and then it's 7:30, right? You just keep moving around very quickly. Don't tell anybody, Rick, but here's the dirty secret. It's just between you and I. You've made more money by far investing in gold, a literally piece of metal, than you have in the stock market over the last 6 months.
Yep, but there's another way to look at it. If you haven't done gold and you haven't done the stock market, you haven't made much money.
Fair enough.
Wise
Don't tell anybody
words.
that. Rick Santelli, thank you. All right, that is the Federal Reserve decision.
All right.
Now we will wait to hear from the man
12 minutes.
in charge. That is Jay Powell himself. Press conference.
12
minutes. 25 seconds. That's when the press conference
We're
begins.
back slightly in the
We're
green.
gonna take a very quick break. We're back with more right
Market's
after
trying to digest this. They're trying to predict what in the world is going to be said, what in the world isn't going to be said. We're just vibing it out at this point. We're just pure vibes. All right, here's what's going on in the Mag 7 ever since the announcement. Initial reaction was a little bit of a pop, and then calls are kind of flat. Puts are drifting to the upside. Once again, that's for the Mag 7. Looking at the S&P 500, same thing. Calls popped, dropped, and kind of flat, and puts were pretty much flat that entire time. So we're not seeing large bets being made by any means. By any means. It's just, we're just waiting. We're just waiting. Is Trump live? No. Why would Trump be live? This is Powell's show today. Daddy Powell's letting us know what in the world is going on. So, well, the initial thing, still a large reaction, but the net of the reaction was actually kind of nothing. We had a big pop, big drop, and now the net is nothing. So if you played it on your Apex or Take Profit Trader accounts to get a test pass, congrats, because you probably got a pass in either direction. Now, if you played it to actually legit trade, well, you probably got blown out. So I hope you played it in the right way. I hope you do. Trump cannot fire Powell. It would be extraordinarily difficult for him to fire Powell. Extraordinarily difficult, and even if he could, it would get so caught up in the legal system that we would be at the end of his tenure anyway, so there'd be no point. So the net of it is that he can't get rid of him. He has about a little bit less than a year left on his term. It's May of 26, and like I said, it is very legally ambiguous if he could get rid of him. Most likely couldn't. Even if he could, it would be discussed and fought about for so long that he would literally just be done. It would take more than a year in the legal system anyway. So no, he's not going to get rid of him. He's not going to get rid of him. I honestly don't even think he wants to. There's if you listen to Trump himself is like, yeah, cut the rates. But no one who knows about Wall Street and no one who has studied economics is saying we should be cutting rates right now. So I know it seems like there's a loud voice of cut rates, but remember, that's just people echoing what the president has to say. You're not going to find a person who's informed about the market, informed about the economy, informed about tariffs, informed about trade, who is saying they should cut rates. It's just Trump and Trump's following. Hence why the market knew there was a 99.9% chance we're not getting a rate cut. Are they bringing us Rick again?
All right, the stock market up 100 points on the Dow, the NASDAQ up about 0.3%. No change in the equity markets. They are slightly higher, in part because the Federal Reserve made no change on interest rates. It kept rates exactly where they were, although the projections for future rate cuts came back just a bit. In other words, we may go the full year, we don't know, may go the full year without a rate cut at all. Joining us now to talk about it all, Loretta Mester, former Cleveland Fed president, now adjunct professor of finance at the University of Wharton, also
Mester, she was just a Fed member last cycle.
That you are here, Loretta. If you were still on the Fed, what would your decision and expectation for rate cuts
Did Trump say anything yet?
Yeah, I would have probably already been at one cut as opposed to two, so I may not have changed my SEP. Remember, the SEP, the one that we had before was in March, and that was before the April 2nd announcement on tariffs. So it moved kind of the way you would have expected, right? Growth, right, they took down a bit. Inflation, they took up. And even though the median, and remember, these are individual forecasts, and then they compute a median after the amalgam of those forecasts. Even though that didn't change, the weight sort of moved toward one cut as opposed to two. So again, we're a higher path for policy this year and next year. So all that I think is expected. The one thing I didn't expect is for them to say that uncertainty has diminished. I would have thought they would have just said it remains uncertain, not that it increased more. But so that was a little bit of a surprise, but I also think that's because the economy has been pretty resilient.
Slow bleed off.
The labor market is holding up well. Growth is rebounding from the
All right, we're about 7 minutes out from Powell, and right now Mester, an old FOMC member,
there's more
speaking.
Clarity about the strength of the economy, but the question is, what's the economy going to look like in the second half of the year?
Can you answer your own?
They're telling us.
Answer your own question.
No, I think what they're telling us is they see that these, even though we don't know the size of the tariffs and, where they're ultimately going to land and their effects, that they are going to hold here for now because the impetus from those tariffs are higher inflation, at least for a time, and a bit weaker growth and a little bit higher unemployment. And they need to do what they have to do, as the chair has been telling everyone, to make sure that inflation and inflation expectations remain anchored. So even though they may look through the price increases that come from tariffs, there's no compelling reason for them to make a change now in the policy rate with the economy performing pretty well, and there's still uncertainty about the second half. So I think they made the right move today by doing nothing with the funds rate, and I think the hold and see until they get a little more clarity. As one of your guests had said, we also have the budget bill working its way through Congress, and that'll be part of the outlook as well. So I know you were talking, Brian, they can just change the those dots whenever they want.
You were the one making the plots, the dots on the plots.
Right, but remember, we change them. Any forecaster will change them based on incoming information and how that informs their outlook. So I don't think it's a bad thing that the forecasts are responding to incoming economic data. I think that's a good thing. And I think it's the change from one SEP to another that's very informative. And I think today we got informed that, the bulk of the committee is thinking that we're going to need a slightly more restrictive policy stance than they had thought at the time of the March meeting. I think that's very clear in this.
And I don't
this SEP.
I agree. I mean, you change your forecast for anything based on your known information at the time, right? My flight will land at 4 p.m. then it's delayed because you chose to fly out of Newark, sadly. So you got to call and say, well, I'm going to be delayed. I'll land at 6. You change your expectation based on what you have at the time. I guess my point, Loretta, was when I look at the CME's FedWatch tool for next year, I see 6 different expectations, all within a relatively similar band, variance a little bit, of ideas. These are some of the smartest, like you, economists in the world. And I guess my point is there doesn't seem to be a lot of visibility to next year.
No,
well,
I
think
know.
That underscores what the chair has been saying, which is there's a lot of uncertainty still here. But, you know, when you're doing this kind of policy making, you're doing 2 things. You want to minimize the risk that you're going to make a policy mistake. And you also want to minimize the cost of any policy mistake you might make. So right now, it's not that costly to hold, right?
Yeah.
The economy's doing well.
The stock market's within 2% of an all-time high.
Growth in employment is holding up pretty well. It's moderated, but that was to be expected, right? And even the latest inflation news is pretty
people that
good.
Are watching.
So with that environment, you don't have to move right now, but you got to be prepared if the economy changes in the second half.
Thus far, kind of a nothing
I think they're in a
burger.
position to be able to respond once they see how the economy is evolving.
Somebody,
and, you know, before this, I know there's a July meeting, but think about the next September meeting where we're going to get SEPs. You're going to also have a lot more economic data coming in.
Well, the bond market, somebody said earlier,
just keep interrupting.
Somebody said earlier in the show,
shut up.
They don't buy barrels of oil, Loretta, but they use gasoline. I thought that was well said because most of our viewers and listeners, they're not trading interest rate futures, but they might want to buy a home. And they're watching mortgage rates. And the bond market already did move.
No, that's true. But also think about the way people's expectations about future inflation are formulated. The gasoline price is one of those prices that really matter in terms of inflation expectations. So what I expect to hear in Jay's press conference today is that the Fed is still
We're going down in like
very focused on making
minutes.
sure that it
going
does
down.
policy that will actually support that anchoring of inflation expectations. And I think that's part of what they're doing with this hold and see strategy.
Pinned to 6,000.
Loretta Mester, we're sure glad you're on our team. CNBC contributor, super smart. Thank you.
Thanks, Brian.
Thank you very much.
We popped,
all right,
we dropped,
let's bring
we
in now
popped,
our
we
senior
dropped,
markets
we popped.
commentator, Michael Santoli, as we await Jay Powell. Is it, Mike, we got an empty podium, but soon to be filled by Jay Powell. Is there anything the market wants that podium and the person behind it to say?
Unchanged.
I think the market always wants the Fed chair to convey a sense of flexibility and willingness to move relatively quickly in response to data, in particular if the economy does weaken from here. I'm also interested to hear how Chair Powell characterizes the summary of economic projections, the dot plot, because there are times when he says, oh, he tries to dismiss it. You know, we just write this stuff on a piece of paper. It's not an authoritative plan or outlook. It's not definitive guidance. And there are some times when he kind of leans back on it and says, look, the committee is not prepared to work yet.
Yields are
it's
going
interesting
up. Makes
that
sense.
you have very few members below the median in terms of rate cuts. In other words, who think there could be more than 2 rate cuts this year. And you have 9 members who think there could be none or 1. And so to me, the skew is the barrier is pretty high for cutting rates right here.
Jesus.
An investor has to assume the Fed's kind of not part of the game for the next 3 months because you got an end of July meeting, you got Jackson Hole, then you're talking about September, which means good news for the economy is what you're rooting for. Good news is good news now.
20 seconds.
This is supposed to be a family show.
How much does the Federal Reserve even matter right now?
I don't think they matter a ton right now. It's market rates. It's like the longer-term part of the Treasury curve. And because the Fed has intentionally taken itself to the sidelines and trying to make full use of this luxury of what they perceive as a luxury of...
Shut up. All right. I think they are getting this ready over here. Where's the volume? All right. We got it. We snagged it.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum
Daddy Powell is here.
Stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid.
Breakout?
Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures.
It is selling.
The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about, responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjusted over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term as you get out to the later years. It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point, it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamarosa, The Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things. And I think as the data come in, you should see those differences diminish.
If I could follow up, you've said that policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Mr. McKee.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
Look, from my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with a strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Andrew.
Thanks, Mr. Chairman. I guess with workplace raids picking up significantly, what kind of effect would that have on the labor market in the short term?
With what picking up?
Workplace raids.
So you're asking immigration?
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of, how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Well, the forecast for inflation in December was 2.5%. Core PCE for 2025, the forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be, we've learned that tariffs are going to be substantially larger than forecasters generally thought. And we don't, our forecasts are generally not particularly different from those of other, well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming and that would mean higher inflation. That's what happened. And so you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans. Small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now, and inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs, because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind, or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years ago talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right? So it's always forward-looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment. You talk to business people now. There's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So, again, we think that our current stance of monetary policy is in a good place.
Thank you. I'm Mara Mokwe with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no. And I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we do. We work hard. But I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public. We're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it again respecting that we have critical missions to carry out. I've had experience, a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions, and I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so, we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually, really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin, I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil. Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks, and worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, for the good of the general public.
Victoria. Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that, a new chair might want to come in and go in a completely different direction. I really don't think that's right. But but that's not going to be up to me to decide.
Is that affecting at all who you're consulting with?
Not at all. Not in any way.
Thank you. Chair Powell, Matt Egan from CNN. Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation? And what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. The question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points, because, AI should be creating jobs at the same time. It may be replacing, may be doing both. Anyone who's done any work with AI will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Greg.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the movements of the dollar was impacting the economy. Are we going through something like that now? That, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint, you see this not just here but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. I mean, and it doesn't change our objectives or what we need to do. And these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know, though. So, but you're right. But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Mark. Mark Hamrick.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. I mean, at the margin, remember, you're at 4.2% unemployment. That was, for many years, that was a extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is there are not a lot of layoffs, but there are not a lot of job creation. If you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very, very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S. economy has defied all kinds of forecasts for it to weaken, really, over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
Go to Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So, I think, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, it's think of it as the least unlikely path in a situation like this where uncertainty is very high. I think, again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence. So I would just say it that way. We don't rule things in or out. Certainly a hike is not the base case at all. It's not something people are writing down. But in the meantime, we do the best we can with these forecasts, and I think they're representative of the different forecasts and different reaction functions that people on the committee have. So thank you very much. Thanks.
Well, folks, there you have it. It got a little bit funky there for a second when we took out the low, but what is saving it actually has nothing to do with the Fed. Why we are popping right now, or why we stopped selling at least, is a little bit more to do with this. Right here, Trump on Iran. I have not made a final decision yet. 5 minutes ago, breaking Trump. Iran wants to come to the White House. I may do that. So it's more of an Israel-Iran update that kind of caught the bottom right here. Even though we took out the low, even though we took out the close and both went red, we're getting a little bit of a pop here because of that, which is unfortunate for me because I cut my calls and switched over to puts on the breakdown of the closing value right here. I was like, all right, time to just bail and flip. And then not long after that, we got this update. With respect to what's going on at the Fed, it was legit bearish. I mean, they think unemployment's going up, GDP's going down, and inflation's going up, like across the board. The only thing that could have been more detrimental for the market in reality would have been something along the lines of, like, hey, we're actually hiking rates because we think inflation's going to be that bad. Obviously, that didn't happen, but just from a pure breakdown of the Fed update, they are not optimistic. And you could see that in the market. We popped on the fact of whatever, bots being stupid, and instantly dropped. Things got a little bit calm as Powell started talking. And then really when they realized that, hey, they're seemingly more hawkish than dovish and things are not looking good in their opinion, we took a clear hit. And what saved us was the exact announcement of, hey, we're chit-chatting with Iran. So do I think the timing of it is a bit interesting? Well, of course I do. I think that's very, very interesting timing, that right when the Fed had stuff going on. If you're bullish, Trump saved you right there with that. If you're bearish, well, Trump kind of knocked you on that one for sure. But it was the fact that we didn't get a rate change. I see some of you talking about it in chat. Anyone with a brainstem knew we weren't getting a rate change. Like, literally, there was a 99.9% chance we were staying exactly where we were. So I'm seeing some commentary of people being surprised about the rate staying flat. We knew it. It was actually, like, well known. Literally 99.9% accuracy. The crazy thing is more of how all the SEP updated the summary of economic projections and how it got a little bit more, I guess, negative. But then they are continually walking that rhetoric back, which is so strange because they're like, hey, yeah, like we are more negative, but we could change this whenever we want, and you shouldn't be putting that much faith in it. So even if, like, what I don't get is, even if the Fed is going around saying, yeah, these ones don't matter, then why do it, brother? why do it? If everyone and their mother, if mainstream media, individual content, and the Fed themselves all say like this shit does not matter, then why are we doing it? Because the bots react to it like crazy. But if everyone talking about is like, yeah, don't put that much weight into it, then what are we doing here? What in the world are we doing here? So that would be interesting if they could answer that one for the team, but I doubt they will. I doubt it. But I'd be curious to know what's going on there. So it's been messy, but the reason it's been messy, it's not really because of the Fed. Like the Fed stuff was kind of straightforward, not to be the most bullish thing ever. But why we're getting a bit of a pounce was, I mean, look at the timing of it. Trump, it's possible fighting is necessary to block Iran nuclear. Wait, what was that update? Jesus. Let me reload this one. Trump, it's possible that fighting is necessary to block Iran nuclear conference ends. Can I find this? Is he live somewhere? Fox.
More than 60,000 releases. What do you attribute that success to?
I like you. Who are you with?
Turning Point USA, sir.
Well, they're very good. Turning Point, Charlie, very good. That's what I call a good question, fellas. 1 out of 10, John. 1 out of 10, but that's a really good question. No, we had record good numbers on the border. And people are coming in, but they have to come in legally. Like some of these guys behind me, they have to come in legally.
Yeah,
and
live
if they come
now.
In legally, we want them. They have to say they love America, they love our country. And if they can't say that, we don't want them. Thank you very much. Very nice. Thank you very much, everybody.
Thank you, press.
Thank you.
Thank you, guys. Thank you, guys. Thank you.
Thanks. Thank you.
That's it.
Thank you, Mr. President. Thank you very much. Thanks, Pulitzer Prize. Fella, hey, Doug, take a good picture. Pulitzer Prize winner. New York Times Pulitzer. The Times is the bad part.
All right, there you have it. That was President Trump as he was speaking in the Oval Office. And as you heard, a lot of questions coming in, a lot related to Israel and Iran, that conflict there, and the potential U.S. involvement. And one thing he did mention is that the Iranian officials, the high-ranking officials, have asked to possibly visit the White House, and President Trump says he is considering the possibility of allowing them to do so. Again, a lot developing here just within the last several hours. So we'll keep you updated, as always, with up-to-the-minute information right here on Live Now from Fox. Do want to take you out to this live image right here that we do have over Tel Aviv at this hour, as we know that sirens were once again sounding just hours ago as there were more missiles that were fired by Iran into Israel. There was at least one injury that was reported, and it did sound as though it was a minor injury, but for the most part here, it appears that there are no serious incidents, casualties, anything as a result of that 6th day of rocket fire from Iran into Israel. Now, Israel saying that it did continue to strike those military sites over in Tehran earlier today as well. That was hours before Iran did launch that retaliatory strike there on Israel. Again, as I've mentioned, we will keep you posted right here as we have those developments on Live Now from Fox. Also do want to take you out once again to this live image over in Massachusetts, as we did get the verdict a short time ago in the Karen Reed retrial. We do know that there were 2 not guilty verdicts that were read on the murder and manslaughter charges, but on operating under the influence, Karen Reed was found guilty of that charge and has been sentenced to 1-year probation. We do have several different live images. This is actually an aerial image coming in from outside the courtroom, and it gives a good idea of just how many people are gathered out there. Obviously, a lot of media members, as they are awaiting Karen Reed to walk out. We know that she's talked to members of the media a lot, so it's likely she will make some comments here. We saw her crying in the courtroom right after the verdicts were read. Again, if she does make comments, you can watch them here live and in full on Live Now from Fox. And again, you can see just how many people are gathered out there. If they pan over just a little bit, you'll be able to get a better look at that. You can see a lot of folks who are supporting Karen Reed, who have been dressed there over in pink. This has been a situation that we have seen playing out. And it does look like we have another live image that is coming in, an aerial shot, but looks like they are zooming in elsewhere rather than at the courthouse. Not sure. They are following a bus there. Not sure why, but it looks like they will pan right back over to the courthouse here in
Not
just
sure
a second.
why.
Again, 2 of the charges not guilty. 1 guilty charge. Verdict coming in here against Karen Reed, and that was
I want
for
more of
operating
this
under the influence.
Israel-Iran
She
update,
was
'cause
sentenced
that's
to
what saved the
1
market
year probation.
momentarily.
As we zoom in outside the courthouse,
We
you can
almost
see
cracked a
folks
new
are
low
waiting
right there.
for the arrival of Karen Reed as she leaves the courthouse and likely speaks with members of the media. Do want to head to a quick 2-minute commercial break right now, but we will reset
A quick
with all of your
2-minute
breaking news
commercial
coming up in
break.
2 short minutes. Stay with us.
A quick 2-minute commercial break. All right, folks. All right, what are you guys chit-chatting about? What do we have going on over here? Well, I don't know. This all seems so incredibly messy. So incredibly messy, the whole thing. We almost cracked this low, but alas, we did not. Here's a look at the options flow. Mags having dump, pop, selling off a little bit. SPY not looking the most healthy, but it did triple bottom kind of right at this level of 5975, which is not only the intraday low, it's a low from yesterday. So 1, 2, 3, but it's also a major open interest level. It also happens to be the bottom of the transition zone, which is why every single day you should be marking this out. Who knows? There's still quite a bit of time. There's 29 minutes left in the day. And I mean, it's not like we have the most time, but a lot of stuff can happen in 29 minutes, especially heading into a market holiday. Tomorrow, it's Juneteenth, and then OPEX on Friday. But 1, 2, 3 distinct saves right here, maybe running into a bit of resistance up at the closing value. The SPY break even, Qs break even, Russell slightly green, Bitcoin at 104. 104. What a mess we have found ourselves in, team. What a mess, what a mess, what a mess. I suppose my question for all y'all is, are you going into this holiday, potentially an extended weekend? Are you going in flat? Nothing? Are you going in with calls? Are you going in with puts? Are you going in bullish or bearish, given everything going on? Obviously, the Fed update was more likely to be interpreted as bearish than bullish. But this Iran-Israel thing, well, that's exactly what saved us right here at 313. Just a huge pop. And then that got faded, but then dip buyers came in at the bottom of the gamma delta zone. So market open half day, right? No, not at all. The market's closed tomorrow. I don't know where you're getting a half day. For the equities and options market, it is fully closed. Fully closed. I don't know who told you that it was a half day, but it is in fact not. It is in fact not. So be careful if you think you're doing something. But and afraid, you're afraid. Interesting. I guess if you're afraid, you're afraid. Maybe size down. Just getting real choppy right now. All right. Well, yeah, look at that. Dump, pop, dump, pop. It just keeps reacting to this key level. So something to pay attention to for the remainder of the day. I think there's some reasonable sentiment to this concept of maybe just chill and wait for Monday. Just chill and wait for Monday. Because this is looking messy. All right, folks, I wish you best of luck with whatever form of degeneracy you decide to get into. Market's closing in about 25 minutes, so obviously good luck. And whatever you do, maybe probably size down in this type of crazy environment, but at the end of the day, I'm not your mom, so I just straight up wish you the best of luck. I appreciate all the good vibes. I'll catch you in the next one. Have a good one. Peace.